Hey there, financial explorers, and welcome back to the channel. Today, we're diving deep into a stock that's showing up on our hard-to-borrow screener with some truly eye-watering numbers. We're talking about NCT Cayman Limited, trading under the ticker NCT. What makes this micro-cap marine shipping company so interesting right now? Well, stick around, because we're going to dissect its unique setup, explain why it might be hard to borrow, and what that could mean for potential short squeeze mechanics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into it with NCT. NCT Cayman Limited operates in the industrial sector, specifically within marine shipping. Through its subsidiaries, it provides maritime shipping services across Hong Kong and internationally, offering time charter and vessel management services. Interestingly, they also dabble in the processing of pulp, paper, and paperboard products. This is a microcap company, meaning its market capitalization is relatively small, which often means lower liquidity and higher volatility factors, always worth noting. Looking at the recent price action, NCT has been making some moves. Today, it's up plus 2.37%. Over the last 5 days, it's seen a plus 1.76% gain, and looking back over the last 30 days, it surged an impressive plus 18.49%. Chart highlighting recent price action volume-wise, today saw 1,052,400 shares trade hands, which is a significant bump from its 30-day average volume of 650,610 shares, giving us a relative volume of 1.6 times the average. This indicates increased interest. What's cost to borrow and why it matters? Before we get further into NCT, let's quickly explain what cost to borrow or CTB actually is. When a short seller wants to bet against a stock, they first have to borrow shares from someone else, typically through their broker. They then sell those borrowed shares, hoping the price will drop so they can buy them back later at a lower price, return them to the lender, and pocket the difference. The cost to borrow is the annualized fee they pay to borrow those shares. It's essentially an interest rate. If a stock has a high CTB, it signals high demand from short sellers to borrow the stock, combined with a limited supply of shares available to lend out. This direct financial cost is crucial for short sellers, as it eats into their potential profits, or even accelerates their losses if the stock goes up. And yes, these fees can easily exceed 100% annualized. If you held a short position for a full year with a 677.5% CTB, you'd pay almost 7 times the value of the shares just in borrow fees. Why this stock is hard to borrow right now. Now back to NCT Cayman Limited NCT and why it caught our attention. The cost to borrow fee for NCT is an astounding 677.5% annualized. That's an incredibly high figure and tells us immediately that short sellers are paying a premium to hold their positions, or that available shares are extremely scarce. Speaking of scarcity, the estimated float for NCT is just 0.3 million shares. To put that in perspective, a small float means there are very few shares available for public trading. When you combine that tiny float with a sky-high cost to borrow, you have a recipe for potential volatility. Currently, the number of shares available to borrow is unknown, which often indicates extreme tightness in the market for those shares. Our internal composite squeeze score for NCT, which considers factors like CTB, borrow supply, float size, and price momentum, currently sits at 42.5 out of 100. While this is not a guarantee of a squeeze, it highlights conditions that warrant closer inspection. It's also important to remember that a high cost to borrow doesn't automatically mean a squeeze is imminent. It can also reflect strong conviction from short sellers who are willing to pay these steep fees because they believe the stock will eventually drop significantly. Squeeze mechanics explained. So, what is a short squeeze and how does a situation like NCT potentially lead to one? A short squeeze happens when the price of a heavily shorted stock rapidly increases. As the stock price rises, short sellers, who are betting on a decline, start losing money. Add to that the increasing cost to borrow, like NCT 677.5%, and their losses accelerate. At some point, these short sellers face margin calls or decide the losses are too great, forcing them to cover their positions. To cover, they have to buy back the shares they initially borrowed. This buying pressure, especially when many short sellers are doing it simultaneously, drives the price up even further, creating a cascade effect that squeezes more short sellers out of their positions. The smaller the float, like NCT 0.3 million shares, the more amplified this buying pressure can become. Dilution risk check. An important consideration for any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This can dilute the value of existing shares and, critically for a squeeze thesis, provide new shares that short sellers can use to cover their positions, thereby easing the squeeze pressure. For at NCT, we've performed our checks and found no recent dilutive SEC filings, no -1s, -3s, or 424 BS in the last 90 days. Furthermore, there has been no recent reverse split for NCT in our look-back window. This is a positive sign for any potential squeeze scenario, as there's no immediate new supply of shares hitting the market that could offset buying pressure or give short sellers an easy out. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For NCT, with its industrial marine shipping business and tiny 0.3 million share float, here's what to keep an eye on. Continue to monitor that astronomical 677.5% cost to borrow fee. Any sustained increase or even maintenance at this level indicates persistent pressure on short sellers. Look for any information regarding changes in borrow availability as shares become even scarcer. That's a key indicator. Watch for continued spikes in relative volume, currently at 1.6 average, as increased trading activity could fuel momentum. Should chart highlighting volume borrows. Pay close attention to price action and key technical levels. While the stock has seen a solid plus 18.49% gain over 30 days, sustained upward movement on increasing volume could force more short covering. Remember, with such a small float, even moderate buying pressure can have a significant impact. So, Intercont Cayman Limited NCT presents a fascinating case with its microcap status, a tiny 0.3 million share float, and an incredibly high 677.5% annualized cost to borrow. The lack of recent dilution risk is also a factor to consider in this unique setup. While the conditions are certainly interesting, remember that a high CTB is just one piece of the puzzle, and it never guarantees a squeeze. As always, do your own thorough due diligence. If you found this deep dive into NCT helpful, please give this video a like, subscribe to the channel for more hard-to-borrow stock education, and let us know in the comments if you're watching NCT or if there are other tickers you want us to cover. We'll see you in the next one.